Joining us from Seattle, we have Russell Investments head of economist for North America, Michael Dueker. Mike was also an assistant vice president for the Federal Reserve Bank of St. Louis, and he was an economist there for more than a decade. And Mike, what a pleasure to have you on with us today. What do you make of the Fed speak? I'm going to get you to translate.
Well, yeah, good morning, Susan. I think that with the basic statement, the Fed ran some risk of looking like the Bank of Japan circa 1998-2001, and the fear would be that the Fed would just have a zero interest rate for an indefinite period with no backing up by quantitative easing. However, the Fed's original line of thinking before this recent spate of bad news in the economy was that by standing pat on interest rates in a gradually improving economy, that is a gradually more accommodative policy. However, with the recent weakness, that line was going to fall apart a bit. So I think that's the reason why they gave a date now out in the mid-2013, because that means that by promising to be accommodative as the economy improves out in the future, that promise today could generate some more confidence.
Okay, well, let me ask you about Jackson Hole, Wyoming. Is this the most that the Fed will do, or are you expecting QE3 to be announced at the symposium at the end of this month?
That'll be data dependent. I don't think it's necessarily going to happen at Jackson Hole. However, I think the Fed is perhaps closer to QE3 than you might think. The Fed is not going to let the 10-year Treasury yield linger so close to 2%. If that doesn't turn around soon, I think you will see some QE3. The primary purpose of QE3 is really to get people to believe in higher growth interest rates in the future. They're not going to let the Fed won't let the interest rate linger where the Bank of Japan has at rates below 2%. They want the 10-year Treasury rate to reflect a belief in growth and not in economic stagnation and deflation scenarios. So I think with the way the 10-year interest rate behaves today, the Fed is going to call for quantitative easing if the rate lingers at less than 2.25% for a very long time.
At less at 2.25%. Okay. Well, let me ask you then about this, I guess, their assessment of the U.S. recovery, because they're saying that growth is disappointingly slow. Are we at stall speed? Are we at double dip speed?
Our call is not that there'll be a formal double dip recession. However, we do see very slow growth in the third quarter. Our point forecast for GDP growth in the third quarter this year is 0.7%. We also see very slow employment gains. Employment gains less than last month's 117,000 for the next 4 months. So it's going to be hard to distinguish from a recession in the near term, and that might push the Fed, and it'll hold down the long-term interest rate. So that might push the Fed towards quantitative easing before the end of the third quarter.
You know, we have three dissensions to basically putting a timeline to how low these interest rates will stay in the economy. What about this change on the Federal Reserve Board? You know, we have 2 vacancies right now. How do you think this might change policy in the future?
Yeah, there's sort of 2 ways to interpret it. First of all, you might think that by overcoming 3 dissents, Ben Bernanke is taking the reins by himself, and he's just saying, I'm driving this policy, I'm driving the committee, I don't care if there are 3 dissents. That's one way to view it. Another way to view it is that the Fed today was dangerously close to not being able to put in that definite 2013 date in their policy statement. Suppose that Charles Evans of the Federal Reserve Bank of Chicago had voted against the policy. Then the vote would have been 6-4. That's not a good sign. That would not have helped confidence today. You never would have seen the market go up as much as it did today if there had been a 6-4 vote release. Now, I don't think the Fed ever would have allowed that to happen. If there were 4 dissents, they would have changed the language. That would have forced Ben Bernanke to remove the May 2013 language from the statement today. So if I were Ben Bernanke, I would imagine that he is calling the senators right now and telling them to approve the nominations and get the Federal Reserve Board up to full strength soon, so he's not facing these 6-4 possibilities. An 8-4 vote would be a much bigger cushion for him.
All right. Great insights, Mike. Thanks for sharing your time today. Mike Dueker of Russell Investments. He's the head economist for North America. Now let's take a look at